Welcome to Auto News Talk. I am incredibly excited you are joining us because the automotive retail landscape is undergoing a massive, entirely hidden transformation right beneath our feet.
Oh, absolutely. It's huge.
Yeah, we are looking at this fascinating collision between what's happening out on the physical showroom floor,
Right.
where buyers are essentially scrambling for affordable vehicles, and the back finance office, where a sweeping regulatory revolution is completely rewriting the rules of how cars are bought, sold, and maintained. Okay, let's unpack this.
It really is a complete paradigm shift. I mean, if we connect this to the bigger picture, we aren't just looking at isolated industry updates or, fragmented policy changes.
Mhm.
We are walking step by step through the entire modern car buying journey.
Okay, I like that framing.
Yeah. So we're going to start out on the lot to see how severe inventory shortages are forcing buyers to radically change their shopping habits.
Right.
Then we will move inside to the finance office, where regulators are stepping in with massive, unprecedented new oversight rules.
Which is a whole situation on its own.
Oh, completely. And finally, we will look at how technology is stepping up to act as the ultimate bridge between those two colliding worlds.
I think that is the perfect roadmap for us. So let's start right out on the pavement. If you walk onto a dealership lot right now, the vibe is entirely different than it was a few years ago.
Totally different.
The overarching theme is that consumer demand is dramatically shifting toward older vehicles. And the simple reason is that the availability of newer used cars is essentially drying up.
That is exactly what the data is showing us. If we look at the insights published by Motors,
And just for context, Motors tracks a massive amount of market pricing and inventory data, right?
exactly, they're a major platform. And they paint this really vivid picture of a market that is essentially splitting in two.
Right, and it's a fascinating split. The Motors data shows that the overall average used car price is hovering just under 18 grand at 18,000 pounds, which seems relatively stable on the surface.
Yeah, on the surface.
But when you look under the hood, so to speak, the age of the vehicle dictates wildly different pricing trends.
What's fascinating here is that the nearly new vehicles, cars under 2 years old, are actually softening in price.
Mm-hmm.
They've dropped slightly to an average of around 28,700 pounds.
Mm-hmm.
But the older vehicle bracket,
They're going the other way.
they are absolutely surging. According to the Motors data, cars in the 5 to 10-year bracket are up 4.5%,
Wow.
sitting at around 13,800 pounds. And vehicles 10 years and older have jumped an incredible 9%.
Wait, hold on. So a 10-year-old car is actually appreciating in value by nearly 10%.
Yeah, almost 10%.
That seems incredibly high. Is that purely a budget issue, or is there something else driving that specific age bracket?
It's a combination of factors, but budget is the primary driver. The research points out that limited availability of supply-constrained model years is the root cause.
From the supply chain issues.
Exactly. If you think back to the global supply chain disruptions from a few years ago, we simply didn't build enough cars.
Right.
Because those cars weren't built, they don't exist in the used market now. So if you can't find that nearly new car, or you simply can't stretch your budget to afford one that sits at nearly 29 grand, your only option is to broaden your search into much older models.
That makes a lot of sense. You are essentially forced down the age ladder.
Precisely. And that shift in consumer behavior is undeniably stark. One of the most memorable details revealed by the Motors tracking is that cars aged 5 to 10 years captured a massive 36% of all online ad views.
Over a third of all eyeballs are looking at 5 to 10-year-old cars.
Over a third.
That is a huge concentration of buyer interest, zeroing in on a very specific, affordable segment.
It creates a very interesting dynamic for the dealers themselves. The data highlights that franchise dealers, the big name brand lots, are turning their inventory the fastest. They take an average of 22 days to sell a vehicle. Independent dealers, on the other hand, take longer, averaging 46 days.
Right.
But they are successfully capitalizing on this older stock tilt. Their advertised prices are actually edging higher because they happen to hold the exact type of inventory that cost-sensitive buyers are actively hunting for.
So the independents are essentially sitting on a gold mine of older stock.
They really are.
But what about electric vehicles? We hear so much about the EV transition. Are people hunting for older EVs too?
There is a really interesting subplot happening there. The same Motors insights indicate that EV momentum is indeed shifting. Battery electric models reached a record 10% of dealer sales,
Okay, 10%.
and alternative fuel vehicles overall made up 21%. However, growing EV volumes are continuing to pressure used EV prices downward.
Interesting.
Yeah, the average used EV prices dropped to just over 22 grand.
Which really narrows the price gap with traditional gas or diesel models.
It does. It makes an EV more accessible to you as the consumer, but it certainly challenges residual values and dealer remarketing strategies.
Right, because the dealers are losing margin.
Exactly. The implication of all this showroom data is huge. These older vehicle segments are essentially propping up the entire market. They are supporting volume for cost-sensitive buyers and sustaining the independent dealers who specialize in stocking them.
But what this data doesn't answer is how long these specific inventory constraints on newer used cars will last before the market normalizes,
Right.
and the traditional depreciation curve finally reasserts itself. We just don't know when a 10-year-old car will start acting like a 10-year-old car again in terms of value.
That is the big unknown on the physical side of the dealership. But let's follow your journey as a buyer. As buyers stretch their budgets for these older, slightly more expensive cars, they inevitably have to figure out how to pay for them.
Always the hard part.
Right, and that brings us off the lot and straight into the finance office.
And this is where things get really intense, because the way those vehicles are financed is facing an unprecedented regulatory crackdown aimed squarely at past lending practices.
We are talking about the motor finance redress revolution.
Right. So for the listener who hasn't been deep in the weeds on this, the Financial Conduct Authority, the FCA, has proposed a phased rollout and a heavily streamlined process for a motor finance redress scheme.
Yes.
This is specifically designed to deliver compensation to consumers who were treated unfairly in the motor finance market.
To give you a sense of scale, the FCA expects that millions of consumers could receive compensation.
Millions.
Millions. This is largely being spurred on by the Johnson ruling.
Let's pause there because that's a huge piece of context. Explain the Johnson ruling like I'm 5. What actually happened?
In simple terms, the Johnson ruling was a massive Supreme Court decision regarding hidden commissions. It essentially ruled that if a broker like a car dealer receives a commission from a lender, they must fully and transparently disclose that to the customer.
Because otherwise, the customer doesn't know the dealer has a financial incentive to steer them toward a higher rate.
Exactly. If they don't disclose it, it creates an unfair relationship. That ruling put the entire lending industry on notice and triggered this massive wave of regulatory scrutiny.
So now the FCA is stepping in to clean up the mess. But if you're a dealer or lender, the logistics of compensating potentially millions of people sound like a total nightmare.
It is daunting. But according to the FCA's proposed phased rollout documents, the regulator is signaling a much simpler process to help firms prepare and to speed up that compensation.
Okay, so how does it work?
There will be an implementation period, likely 3 months, and up to 5 months for older agreements. This time is specifically to allow firms to locate historical records, set up their processes, and train their staff.
That distinction for older agreements is crucial. It's basically forcing dealerships to go on a financial archaeology expedition.
That's a great way to put it.
I mean, imagine trying to dig up a paper trail for a loan that originated 8 or 9 years ago.
Exactly. But the burden is fundamentally shifting. Under this streamlined process outlined by the regulator, consumers won't even need to opt out or jump through administrative hoops for complaints lodged before the scheme starts.
So the consumer just waits.
Pretty much. Lenders must proactively assess and communicate outcomes directly within 3 months of the implementation period ending.
It completely flips the traditional script. You don't have to chase the lender has to come to you.
And the FCA is allowing firms to use a range of communication channels, including digital options, rather than mandating expensive recorded delivery.
Which saves a lot of money.
It lowers costs and accelerates contact. Crucially, consumers can accept these redress offers immediately, rather than waiting for long, drawn-out final determinations.
I think my favorite detail from the FCA's phased rollout documentation is just how aggressively they're policing the perimeter of the scheme.
Oh, the adverts.
Yes. The source points out a staggering metric regarding their market oversight. Regulators have already removed or amended over 800 misleading adverts from claims management companies since the crackdown began.
800. That's a wild number.
Yeah.
There's blood in the water, and bad actors are trying to capitalize on consumer confusion.
Right.
The FCA is actively clearing the field to ensure this redress process is legitimate and protected from fraud.
The implication of all this is that it creates a much clearer, faster path to compensation for consumers. At the same time, it gives dealers and lenders a highly structured, predictable timeline to handle what is going to be a massive volume of claims.
Yes.
Instead of a chaotic free-for-all, there are defined rules of engagement.
But what remains an open question here is the final design and the exact eligibility criteria of the scheme.
Right, because it's not totally finalized.
Exactly. Final decisions from the regulator are still pending as they review thousands of consultation responses. So the industry is essentially standing on the starting block, waiting for the starting gun to fire.
Okay, so the consumer found their older car on the lot. They navigated the highly regulated finance office. They drive home. But older cars break down.
They always do.
They need tires, they need brakes, they need a transmission fix. And that brings us to the service bay, which is our next major area of focus.
And guess who is waiting for them in the service bay?
Let me guess. Regulators.
The regulators.
Because keeping an older car running is expensive. If you get hit with a surprise bill for £1,000, you might not have that in cash. So many consumers turn to buy now, pay later, or BNPL services right at the service desk.
Which used to be a very frictionless process. You just sign and go.
Right.
But according to the FCA's policy updates on bringing BNPL under regulation, this places deferred payment credit firmly within the formal regulatory perimeter.
Okay.
It means consumers will now get access to the Financial Ombudsman Service for unresolved complaints.
So for the customer standing at the service desk, handing over their keys, what is actually going to change?
The changes are going to be obvious. The FCA mandate requires clear pre-contract information. That means upfront, plain English details on total amounts due, payment dates, and the explicit consequences of missed installments.
No more burying it in the fine print.
Exactly. Furthermore, and this is the big one, there will be mandatory proportionate affordability checks to ensure the borrowing can actually be managed by the customer.
So this service advisor basically has to act like a loan officer before they hand back the keys.
In a way, yes.
That introduces a lot of friction into a process that was supposed to be easy.
It does. And lenders will be held accountable for how customers in difficulty are treated after the fact. They must offer clear support, including signposting struggling borrowers to free debt advice.
Wow.
For motor retailers and service departments offering BNPL via third-party providers, this means the checkout experience is going to be far more structured and heavily scrutinized.
The industry perspective on this is very telling. In the coverage of the FCA's BNPL regulation, there's a great insight from Payment Assist, which is a major provider in this space.
Right.
Right.
They argue that the regulation will effectively reset expectations at the point of sale, even if more applications are declined.
That's a very honest take.
It is.
Yeah.
They are essentially welcoming the clearer disclosures and proportionate checks because the ultimate aim is fewer post-sale problems.
The implication is undeniable. This establishes a unified, predictable framework of minimum standards for retailers. It ensures strong, undeniably clear protections for consumers who are literally just trying to fix their cars and get to work.
Yeah.
It forces the service department to operate with the same financial compliance rigor as the front-of-house finance office.
So what does this all mean? We have constrained inventory pushing buyers to older cars. We have a massive historical redress scheme forcing lenders to comb through old records. And now we have new point-of-sale regulations adding friction to service and repair bills.
It's a perfect storm.
It really is. What this doesn't answer is how severely dealer conversion rates might dip at the margins once these strict affordability vetting processes become standard practice.
That's the million-dollar question.
Right. If a customer needs tires but fails the affordability check, how does a service department hit its revenue targets? What does the customer do?
That is the existential question for the modern dealership. With inventory tight and regulators scrutinizing literally every single financial transaction from the showroom to the service bay, dealers have to adapt.
They can't just keep doing things the same way.
The old ways of doing business simply won't work anymore. And the only way to survive and thrive under that kind of pressure is by relying on new, highly integrated technology.
So if dealers are getting squeezed by inventory on the lot and regulators are breathing down their necks in the finance office and the service bay, how on earth do they protect their margins?
Technology.
Exactly. That brings us to the tech side of things, specifically highlighted in a brilliant white paper by Avendi.
And for context, Avendi specializes in automotive retail technology, specifically bridging the gap between vehicle sales and vehicle finance.
Right.
Their white paper assesses how FCA redress, the Johnson ruling, and digital finance are completely reshaping dealer profitability.
The core idea here is that clearer regulatory expectations are forcing an absolute evolution in how dealers make money. The old model of just tacking on a high-interest loan at the end of the sale is dead.
Dead and buried. The Vivendi white paper positions this current era as a massive recalibration phase. Dealers and lenders are actively adjusting their product designs, their technology, and their coordination to align with these tighter standards. And the paper identifies 4 defining shifts that are paving this digital bridge to profitability.
Let's break those down because they show exactly where the industry is heading. The first shift is new motor finance structures. Dealers and lenders are completely rethinking their lender panels.
Yeah.
The goal is to surface offers both in physical showrooms and online in a way that lets customers compare options easily without undermining the dealer's sales process.
The second shift is the move toward price comparison style searches. Think about how you book a flight or buy car insurance online.
You want to see everything at once.
You expect to see side-by-side choices. The Vivendi research notes the industry is moving toward presenting monthly payments, rates, terms, and indicative approval likelihoods all at once, right on the screen.
Which is brilliant because it sets your expectations much earlier in the process. It significantly reduces that awful friction at the very end of the sale, where someone falls in love with a car but then finds out they can't afford the monthly payment.
Precisely. And that ties directly into the third shift, highlighted in the white paper, which is the wider use of pre-approval.
Okay.
By providing an initial indication of acceptance early on, you streamline the entire journey. You guide the customer toward a lender that fits their specific credit profile much sooner, which helps the lenders manage their risk and return ratios much more effectively.
And the fourth shift is the evolution of value-added products, or VAPs. We were talking about things like extended warranties or gap insurance. Dealers are recalibrating these add-ons with much clearer disclosures. They are presenting the value transparently and packaging them alongside the primary finance agreement in a way that is fully compliant and commercially sustainable under the new FCA rules.
But to make all 4 of those shifts happen simultaneously, you need serious processing power. You can't do this with a calculator and a fax machine.
No, absolutely not.
A highly memorable detail from the Vivendi white paper highlights their Finance Navigator tool. This specific technology can search all participating panel lenders for a buyer and return personalized, side-by-side results in under 10 seconds.
Under 10 seconds. I mean, think about what that feels like in a dealership versus the old way of waiting an hour for the finance manager to run your credit and come back with a single sheet of paper.
It's night and day.
It shows monthly costs, personalized rates, estimated approval likelihoods, and pre-approvals instantly.
That speed is revolutionary for the consumer experience. And the implication here is profound. It proves that rigorous regulatory compliance and healthy dealer profitability are not enemies.
That's a great point.
Better digital transparency actually aligns the risks for both the lender and the dealer, while giving consumers the exact kind of clear, informed choices that the regulators are actively demanding.
It's a win-win on paper. But of course, there are always hurdles. What the white paper leaves open is how smaller independent dealers, the very same ones currently thriving by selling those older vehicles we talked about earlier, will actually adapt.
Right, because they don't have the big corporate budgets.
Exactly. With fewer resources and smaller IT budgets, how will a small-town dealer meet the technical demands of implementing these lightning-fast, panel-wide software systems?
That technological divide between the massive franchise groups and the local independents is going to be a critical space to watch over the next few years.
Okay, let's pull all of these threads together. When we look across the entire landscape we've discussed on the show, the motors data on the lot, the FCA's redress and BMPL frameworks in the back offices, and the Vivendi technological solutions tying it all together, 3 major themes clearly emerge.
The first theme is undeniably the push for radical transparency. We see this heavily supported by both the FCA redress plans, which require proactive, unprompted communication of compensation,
Right.
and the new BNPL regulations, which mandate incredibly clear pre-contract terms and strict affordability checks. The days of hiding the financial details in the fine print are over.
The second overarching theme is the era of the value seeker. This is heavily supported by the Motors insights showing massive consumer demand pivoting to cars aged 5 to 10 years old.
Yes.
And it's mirrored perfectly by the Vivendi white paper's emphasis on giving those same consumers price comparison style finance searches. Buyers are hunting for value on the metal, and they are hunting for value on the loan.
And the third theme is the necessity of operational agility. Whether it's an independent dealer physically pivoting their lot to stock older vehicles based on the motors trends,
Mm.
or a dealership's finance and service teams completely overhauling their checkout experiences to meet the Vivendi and FCA standards, operational readiness is no longer optional.
Right.
It is mandatory for survival.
But within those themes, we also have to acknowledge a very deep structural tension. There is a glaring contradiction between the realities shown in the motors data and the regulatory momentum of the FCA sources.
It is the ultimate paradox of this current market. The motors data clearly shows that buyers are feeling cash-strapped.
Yeah.
They are financially stretching themselves, abandoning the nearly new market, and hunting for older, cheaper cars just to get by.
Mm.
Yet at the exact same time, the FCA, BNPL, and redress sources show regulators aggressively tightening the lending taps and mandating strict affordability checks.
The tension is palpable. The very buyers who are most desperate for affordable vehicles and who need flexible, deferred financing the most just to keep those older cars running might actually find it significantly harder to get approved under the new, stricter rules.
Exactly.
The regulations designed to protect them from bad debt might also inadvertently restrict their access to the mobility they need.
Which leads us to our core, practical takeaway for anyone navigating this space. For the entire automotive retail industry, compliance can no longer be treated as a back-office afterthought or a dusty manual on a shelf.
No.
It has to be integrated directly into the sales process as a feature. By utilizing incredible speed and digital clarity, like those under 10-second panel searches we discussed, dealers can actually use compliance to win over cautious, value-seeking consumers.
It's about turning a regulatory requirement into a competitive advantage. If your checkout process is the most transparent, the fastest, and the easiest to understand, the consumer will trust you.
And if you can provide that certainty, you secure the customer for life.
Absolutely. You are listening to Auto News Talk, and as we wrap up this segment, I want to leave you with this final thought. The dealership of the future isn't just about selling a car. It's about selling certainty in a highly regulated, highly unpredictable market.
Well said.
So as you monitor this industry going forward, keep a very close eye on how consumer approval rates for financing fluctuate as these mandatory affordability checks go live across the board. That single metric will tell you everything you need to know about who is adapting and who is being left behind. Thank you for joining us on Auto News Talk, and we will catch you next time.